All right, so it is Tuesday, February 3rd, 2026. The coffee is definitely brewing, markets are waking up, and PepsiCo just dropped their Q4 2025 earnings.
The one we've all been waiting for, it seems.
And looking at the headlines, it feels, I don't know, almost remarkably standard.
It does, doesn't it? I mean, on the surface, it's the very definition of a steady Eddie report.
Right. Let's just get the baseline numbers out of the way so we can get to the real story here. Earnings per share came in at what, $2.26?
Yeah, $2.26. It beat the consensus by just 2 cents.
And revenue hit $29.34 billion. So it beat there by nearly $400 million.
A pretty decent beat, yeah.
And of course, they raised the dividend for, I think, the 54th year in a row and announced a new $10 billion share buyback. So if you're a retiree holding Pepsi stock, you're thrilled. Nothing to see here, right?
If you stop reading right at the headline, then sure. But if you actually listen to what the management team is saying, the whole tone is completely different.
Well,
beneath those, boring, reliable numbers, there is a massive strategic shift happening. They are not just cruising. They are gearing up for a fight.
a fight with who?
You.
Folk? Or with us, the consumers?
Well, in a way, both. But mostly, they're fighting the economic reality of 2026. They're acknowledging something that I think a lot of other companies are trying to hide,
Which is what?
that the low to middle income consumer is just tapped out. They've hit a wall.
So we're broke. And Pepsi knows it.
Pepsi knows it, and instead of just, riding out the storm and accepting lower sales, they've decided to play offense.
Playing offense.
Yeah.
That sounds great in a press release, but isn't that just corporate spin for we lost our pricing power?
That is the skeptical take, for sure.
I mean, usually when a company like Pepsi starts slashing prices, it's because they're desperate, not because they're being aggressive.
And that's a totally fair point.
Yeah.
But this doesn't feel like a panic sale. Management is calling this a surgical investment
It's
strategy.
just surgical.
They've identified that for a huge chunk of the population, the price of a bag of chips has simply crossed a psychological line. It's just too much friction.
I've definitely seen the headlines circulating this morning. I mean, rumors of price cuts up to 15% on huge brands like Doritos, Cheetos, and Lay's.
Yep.
That is not a small tweak. That is a rollback.
It is significant, but let's be clear about that surgical part you mentioned.
Yeah.
They aren't just walking into every 7-Eleven and slashing prices across the board.
Okay.
They are targeting very specific pack sizes and specific stores where that price sensitivity is the highest.
Okay, but help me with the math here. We are in, an inflationary environment. Costs are still up. If they cut the price of a bag of Doritos by 15%, doesn't that just obliterate their profit margin? How do they make money on that?
Volume. It's a classic elasticity play.
Ah,
They are betting that if they lower the price, the increase in the number of bags sold, the unit volume, will be high enough to offset that lower price tag. They just need to get the velocity of the product moving again.
so they'd rather sell 10 bags at a lower profit than, say, 5 bags at a high profit.
Basically. But there's another layer to how they're paying for this. They aren't just eating the loss.
Okay.
This is where all the boring operational stuff becomes. It becomes the weapon. They are funding these price cuts through productivity savings.
Productivity savings is my absolute favorite vague corporate buzzword. What does that actually look like? Are they just firing people?
It's more structural than that. I mean, we can talk about the trucks later, but it's things like automation in warehouses, tighter logistics, cutting waste in the supply chain.
Right.
They are taking those internal savings money they save by being more efficient, and they're passing it straight to the customer to lower the shelf price. They're essentially weaponizing their own efficiency.
Okay, so they get leaner so they can get cheaper. But there's another nugget in this report that really caught my eye, and it connects directly to this whole volume strategy, the shelf space.
The real estate. This is the hidden victory in the report.
Management dropped a stat that I think most people probably just glossed over. They said beginning in, March and April of 2026, they expect double-digit shelf space gains.
In the main aisles and the perimeters of the grocery stores, no less.
Double-digit gains. I walk into Kroger, and the chip aisle is already like 60% Frito-Lay.
Mhm.
Where are they finding this space? And why would a retailer even give it to them? Retailers aren't charities.
No, they rent that space to the highest bidder. But think about it from the retailer's perspective. What does a grocery store manager care about more than anything?
Throughput.
Throughput. They hate products that just sit there gathering dust. They want turnover.
Right.
So Pepsi goes to Walmart or to Kroger and says, look, We are cutting prices on our biggest, most popular brands. These bags are going to fly off the shelves.
Okay.
If you give us more prime real estate, you are going to make more money because the inventory will turn over so much faster.
So the price cut is the bait.
And the shelf space is the trap. Once they
Yeah.
secure that extra space, it creates this feedback loop. More space means more visibility. More visibility combined with a lower price means more sales. They're effectively using their efficiency to buy physical presence and just crowd out the competition.
That is ruthless. It's a land grab disguised as a discount.
It really is. But you can't just win on price and space. You also have to win on the product itself. And, in 2026, selling junk food is getting a lot harder.
Which brings us to their innovation engine. And I have to say, some of this marketing language is just, it's hilarious. They're
Ah.
trying to pivot from salty snacks to what they call kitchen logic.
Kitchen logic. It does sound nice, doesn't it?
It sounds like they're trying to convince me that eating a bag of chips is the same as eating a salad.
Well, sort of.
They're relaunching Lay's globally Super Bowl ad and everything, focusing on farmers and freshness. And they're testing Lay's cooked in avocado oil and olive oil.
And you shouldn't dismiss that oil change. That's actually a huge deal for a certain demographic of consumers.
Avocado oil Lay's. I feel like I'd see that at some high-end organic market for $8, not at a gas station.
And that's exactly the point. They are trying to take the premium, healthy halo and bring it to the mass market. Kitchen Logic is all about the back of the bag.
What do you mean?
They want you to turn it over and recognize every single ingredient from your own pantry. Potatoes, oil, salt. Simple.
So it's about permission. Oh, I can eat this because I know what avocado oil is.
Right. It lowers the guilt barrier. And they're doing the exact same thing with Gatorade launching a version with no artificial sweeteners or dyes. They're trying to recruit the parents and the health-conscious consumers who have kind of drifted away from the, chemical stuff.
Speaking of recruiting new consumers, let's talk about the acquisitions. Pepsi has been buying up these smaller, cooler brands for a while now. Siete, Poppi, Alani Nu.
And 2026 is shaping up to be the year those investments actually start paying rent.
Management used a phrase that I thought was interesting, mechanical acceleration. They mentioned Siete hitting its stride in March and Poppi in July. Why do those specific dates matter so much?
It's an accounting quirk, but it's a really powerful one. When you buy a company, let's just take Siete, the grain-free tortilla chip brand. For the first 12 months you own it, its sales growth doesn't count toward your organic growth metric.
Because you bought it, you didn't build it.
Exactly. So it just sits in a separate bucket. But the day you hit the 1-year anniversary, which for Siete is in March, all of that growth suddenly slides over into the organic column.
Huh.
It's purely mathematical. They don't have to sell a single extra bag of chips, but their reported growth rate will jump because Siete and Poppi are suddenly part of that core calculation.
So the year is mechanically backloaded. They plant the seeds with the price cuts in Q1, and then the math just kicks in during Q3 and Q4 to make the numbers look even better.
It gives them a really nice natural tailwind for the second half of the year.
But there is a massive headwind that we haven't touched on yet. The elephant in the room, or maybe the shrinking elephant.
Yeah, the GLP-1s, Ozempic, Wegovy, Zepbound.
Every single time a food company reports this comes up, is Ozempic going to kill the snack business? And Pepsi's management seems, weirdly optimistic. They're taking an opportunities over threats stance.
Well, they have to. They can't exactly come out and say, we're doomed.
But does their argument actually hold water? They're talking about portion control in smaller bags.
Okay.
But if I'm on a drug that chemically obliterates my appetite, I'm not looking for a smaller bag of Cheetos. I'm skipping the aisle entirely.
That's a fair point.
Is grazing really a behavior they can bank on? Or is that just wishful thinking?
I think it's a bit of both. The grazing theory suggests that people on these meds, they eat less volume, but they still want flavor. So that 1-ounce bag suddenly becomes the default. But the real strategy, it isn't the chips. It's the liquids.
The hydration angle.
Exactly. One of the biggest side effects of these GLP-1s is dehydration. You have to drink a ton of fluids.
And you lose muscle mass too, right?
Yeah.
So you need protein.
Correct. So suddenly, Gatorade isn't just a sports drink. It's a hydration solution for a medicated population. And Quakers or Sun Chips aren't just snacks. They are delivery mechanisms for fiber and protein, which those patients desperately need.
That's actually a pretty clever pivot. They're sort of rebranding their products as functional support for the Ozempic lifestyle.
It's adaptation. They are betting that the user doesn't stop consuming, they just shift what they consume. And Pepsi wants to be right there with the protein bar and the electrolyte water when they do.
Let's shift gears to the rest of the beverage portfolio.
Yeah.
We touched on Gatorade, but what about the energy drink wars? It feels like everyone's walking around with a Celsius or an Alani Nu these days.
They call that the fast-growing profit pool. And Pepsi has taken a very, very smart approach here. They have about 20% market share, but they've done it through a mix of ownership and partnerships.
Distribute Celsius, right? But they don't own it.
They distribute Celsius, which is still growing like a weed, but they also own Rockstar and Alani Nu outright. It's a portfolio bet. They don't need to predict which specific can you're going to buy.
They just need to make sure they're the ones putting it on the truck.
Exactly.
And what about Big Blue? Pepsi itself, the cola.
Pepsi the soda is actually doing quite well. They mentioned that Pepsi Zero Sugar is winning blind taste tests, supposedly preferred by something like 100,000 consumers over the main competitor.
Taking some shots at Coke Zero, I like it.
For sure. But the problem child in the portfolio is Mountain Dew.
Poor Mountain Dew. It feels like it's been struggling to find its footing for a little while now.
It has been sluggish, is the word they used.
Yeah.
The issue with Dew is that it's incredibly regional.
Oh, interesting.
Yeah, a marketing campaign that works in New York City falls completely flat in rural Alabama. So they are having to get very, very local, almost zip code level with their strategy. They think 2026 will be better, but it's definitely a slower turnaround.
Before we wrap up, I want to circle back to something we mentioned earlier, the productivity savings. You said something about trucks.
The plumbing update.
Right. They're running these experiments in Texas and Florida where they're merging the food and the beverage distribution trucks, which, to me, seems obvious. Why send a Frito-Lay truck and then a Pepsi truck to the same 7-Eleven?
Why hasn't this always been the case?
Yeah.
Because historically, those two divisions hated each other. They were run as completely separate fiefdoms with their own cultures. Merging them is a logistical nightmare and, frankly, a cultural headache.
So why do it now?
Because they need the money. This connects everything we've been talking about.
Yep.
Merging those trucks saves, pennies per mile. It reduces the number of drivers, the amount of gas, the maintenance.
Those pennies add up.
They add up to millions and millions of dollars. And where does that money go?
It goes to pay for the price cut on the Doritos.
Precisely. The operational efficiency in Texas is the ammunition for the price war in the snack aisle. It's not just boring logistics. It is the engine room of the entire playing offense strategy.
That makes perfect sense. So let's zoom out and just look at the year ahead. What is the actual outlook for 2026?
The guidance is for 2% to 4% organic revenue growth and 4% to 6% EPS growth. It's not explosive by any means. It's steady. But you have to remember the shape of the year matters.
It's backloaded. We talked about that.
It's totally backloaded. The first half is the investment phase, cutting prices, securing the shelf space, enduring some of that pain. The second half is the payoff, when the new brands kick in, the volume ramps up, and that shelf dominance starts to pay dividends.
So what does this all mean for you, the listener? We've got surgical price cuts, avocado oil chips, and merged trucks. What's the big takeaway from all this?
The takeaway, I think, is that PepsiCo is refusing to be a dinosaur. They're being really aggressive. They see the consumer is hurting, so they lower prices.
Yeah.
They see the health trend, so they change the oils. They see the Ozempic shift, so they pivot to hydration. It's a masterclass in corporate survival.
They are definitely wide awake.
Yeah.
But I have to ask, is there a darker side to this whole thing?
Well, there is a question that I think we need to leave the listener with.
Go for it.
We spent this whole deep dive talking about Pepsi's strategy to cut prices because the consumer is stretched. But think about who we are talking about here. This is PepsiCo.
Right.
They have arguably some of the strongest pricing power on the entire planet.
If people will pay for anything, they'll pay for their favorite chips.
Usually, yes. So if Pepsi, the giant with all the leverage, has to slash prices just to get us to buy a bag of Lay's, what does that say about the true health of the global consumer right now?
That's a little unsettling.
Is this just a really smart Pepsi-specific strategy, or is Pepsi the canary in the coal mine telling us that the economy is in much worse shape than all the headline numbers suggest?
Something to chew on next time you're in the chip aisle looking at that surgical discount.
Indeed.
That's it for this deep dive into PepsiCo's Q4 2025 earnings. Thanks so much for listening, and we'll catch you on the next one.
Take care.